My experience with Alpha so far has been nothing short of exemplary.
The word that would best describe them, I think, would be trustworthy.
They're just a fantastic group of people.
We have a fantastic team in Alpha Wealth. We're all fully qualified individuals with over 60 years of combined experience between us.
I've spoken to so many different people that they feel like they've just like an extra cousin I've never met before, and they're always there with a kind of a helping hand to do whatever I need.
They have a very professional approach, and you feel like you're getting advice that you can trust and rely on.
They're a company that I would definitely recommend to friends and family. Nick and the team are there at the end of a phone or at the end of an email, and they will always come back to you.
Alpha Wealth provide a full range service to our clients' needs just to make sure that you're doing the right things for you and getting the most from your own money, getting it working harder for you and ensuring that your family are protected.
My experience with Alpha so
Hi everyone. Thank you very much for joining the webinar this evening. For those of you that don't know me, my name is Nick Charlambus and I'm the Managing Director of Alpha Wealth, and I'm joined by two of my colleagues this evening, Head of Marketing Keenan Cunningham and our Director of Business Development Cleanor O'Donoghue. We're going to spend the next kind of 25 minutes or so just going through a couple of areas as to how we believe that we can help you reduce your tax by 10,000 euros plus this year. We'd like to make this session as I suppose, interactive as possible. So please do ask questions in the Q&A. We will address them during and after the event. And if we don't get to them, we will come back to you directly. And as I say, we just want to make this as useful as possible. This is one of many series of webinars that we are doing. My colleague Keenan is going to put in the chat function some of the upcoming webinars that we're going to do. Just before I kick off, I just want to start with a poll, which you might answer. We're just trying to get a gauge how much tax people have paid, and you might just kind of populate that just while we go through this. So I'm conscious that some of you have listened to some of the webinars that we have done. For those of you that perhaps haven't, and maybe this is your first webinar that you're listening to, just to mention briefly about Alpha Wealth. We are an independent financial services company. We're not tied to any particular insurance providers. 8 advisors based in Cork and Dublin, and we give guidance to individuals, business owners, PYU workers, self-employed people in all areas of personal finance. And that includes a whole range of things like mortgage advice, pension, savings, insurances, and so on. So just in terms of what I'd like to, I suppose, allow you to take away from this short presentation is specifically how we can help you reduce the tax you pay. Now, some of you may have heard me talk about pensions previously. I think it's a huge opportunity for you and why it's so important, and that you need to make sure that you review it. And the second area I'm going to talk about is the EIIS scheme, or the Employment Investment Incentive Scheme. And finally, I'm just going to talk about how to reduce the tax that your children will probably pay in the future. There will be a Q&A at the end that we'll go through. So just to start off with, I'm not going to labor on pensions tonight. And for those of you listening on playback, obviously, I want to just give you one specific kind of, I suppose, illustration. By putting money into your pension scheme, if you earn over 40,000 euros this year, you will get a 66% immediate gain from making that contribution. The example is if you put in 1,000 euros, you get 400 euros back. To turn 600 euros into 1,000 euros will take a 66% gain, and that money grows tax-free.
So Nick, what is the maximum amount that somebody can put into their pension?
So the amount varies depending on your age and depending on how much you earn. And the illustration on the screen there shows a table at the bottom half. Basically, that for someone say in their 40s, I'm 49 years of age, so I'll use myself as the example. You have the ability to put 25% of what you earn, your gross basic salary, up to a maximum salary of 115,000 cap. That's a maximum amount per month, 2,395 euros. The key thing to understand, though, before anyone balks at that figure, is that you get the 40% relief typically at source. So it costs you €1,437.50. That's a whopping saving of €11,500 back in tax. That's the first objective of how you can reduce your tax bill. The other thing is it does not include your employer's contribution if you work for a company. And if you own a business, the rules are slightly different.
And on that, can you explain the changes that have happened recently and that have been announced around pensions?
There's been a huge landscape change to the amount that people can pay into their pensions, not just employees, but also for anyone who's a director, business owner. You now have unlimited capacity to put money into your pension scheme. The maximum amount that you can put into your pension is 2.15 million. And it enables you, for those businesses that have capacity, to put in significant amounts. And this also would entitle senior management people to also, if they're in a position to get their company to pay into a pension scheme as part of their overall remuneration, that they have massive scope now to take in those contributions. I'm just going to talk briefly about how we help people in Alpha Wealth. And again, I'm going to use myself as an example that for any financial consultations that we do with individuals, we show them a roadmap of where they are currently and where they're likely to end up. I'm 49, as I said. I'm looking at drawing my pension benefits at 63 years of age, so 14 years from now. The reason being is that we have a young dependent who's 8 years of age. And basically, this shows that for €1,000 a month contribution costing me €600 a month net, my pension will be worth, which points to the arrow there, of 728,000 based on certain assumptions that we use. And we check in with individuals once a year. The effective inflation of 3% per annum, which would be a good long-term estimate of inflation, brings it back to about 481,000. Now, before we stop there, the key thing we show people is that it's really important to make sure that you're not paying too much for the scheme that you're in. And this could apply to old pension schemes. And believe it or not, the difference between a management fee of 1.25% to 1% over the period of 14 years for me, based on my level of contribution, is a difference of €42,000. It's enormous. In today's value, it's 28,000, which will effectively give you about a year's less of a working life by just making sure that your management fee is at 1% rather than 1.25.
Is it possible to get money out of the pension before you're 60?
It is. There's this misnomer that people think that they have to wait until they're 65 or till the state pension age of 66. People can access their pensions from any age from 50 onwards. And because of the rule changes that have happened, it has become more effective than ever. And what helps is that we help people understand the different pensions that they may accumulate over their lives, how they can draw them down at different times. There's this, I suppose, thing at the moment where they're talking about phased retirement. They said that there's studies that people find it hard to just retire on one day and do nothing. And what I think will happen is that people are going to start drawing their pensions over a period and supplement their income as their income falls. I'm just going to talk briefly, guys, about the second opportunity, which is a tax scheme called the Employment Investment Incentive Scheme. Now, some of you may have heard me speak about this before. There is a separate webinar video, which again, I would encourage you to look into on our website. And again, Keenan has put it into the chat. But the key takeaway on this is that if you're in a position where you can invest a sum of money, let's use the example of €10,000 here, over a 4 to 5 year period, you will get back €4,000 as a high rate taxpayer. The only qualification is you have to be earning more than €40,000 a year of your investment contribution. And on top of that, you look to get your money back plus the return of your investment. And I've used an example of 20% over the 4 to 5 year period, which is quite conservative, I might add, which essentially gives you back 100% return of your investment. You invest 10 minus 4 to get back 12. It's a really, really powerful scheme. Now, I'm going to talk briefly about 3 opportunities that are available now, today. And we basically review the market. There was about 70 companies that looked for this finance last year. We have no bias, and we act, as I said earlier, as an independent. The 3 companies are Blacks of Kinsale, who are a Cork-based whiskey alcohol distributor, a renewable energy fund through a company called BVP, and there's a new offering, which is an East Cork hospitality, restaurant, gastro bar experience. Now, again, before you balk at that, this is a company that is extremely successful in this sector, that has acquired an asset at a very low value. And there's a huge opportunity, in my opinion, for people to benefit from that under this regime. Very briefly, Blacks of Kinsale, who raised money for EIS very successfully last year. Again, for those of you that heard me speak about them, they're an extremely progressive company, great balance sheet. I think it's a really useful opportunity for a company that, as I said, has successfully raised the money that they needed. And what they're looking to do is basically grow further into this year. You can see on the screen there that they've won numerous awards. Their profit in 2021 was 625,000 euros. Great distribution channel, and I think is a really, really worthwhile opportunity. BVP, this is a fund that's been available for the last 16 years. They select, and they have a really good process of picking sustainable companies that have proven themselves through various different aspects of, obviously, environmental, social governance. And I think it's a good opportunity for people. You can see some companies there on the screen that they've invested in, and it's a I suppose an ideal complement in relation to other aspects of your investment portfolio. The last one is the one I just mentioned, this East Cork hospitality opportunity, which is run through a company called Clistra. They traded previously as Anua. They own a number of hotels, gastro bars. They recently bought and renovated the Viaduct, which is in Cork. And as well as that, they have a number of hotels up and down the country, including a number of Radissons, that they've successfully negotiated through what has been a difficult period. And the company is growing from strength to strength. This opportunity is, I suppose, in terms of Clistra, and again, I can go into more detail with you. I would know the business owners, Paul Fitzgerald and Sean O'Driscoll, and it's a very, very well-run company. The opportunity, as I said, is in East Cork. I won't mention the name as yet, but again, we can provide you more information as to the opportunity. And they're actually paying a coupon of up to 30% over that 4 to 5 year period. And I definitely think as part of this portfolio that we're allowing clients to build, I think it's certainly something worth considering.
So Nick, does the EIS only include your employment income?
One of the key things that a lot of people don't necessarily realize is that the reason why I keep talking about EAAS is that it includes rental income and what I call unearned income. So there may be people who have an investment property, rental, and they don't realize that they can actually invest some of that money that they receive in rent and get tax relief on it, which makes it obviously very suitable, because obviously you pay tax on the rental income you receive, and it's a way of basically getting that back. And I do think it's certainly something as a complement to pensions, not as a replacement, that makes a lot of sense. Just to say as well, guys, before we continue, please do feel free to ask any questions. We just want to make sure that we're able to address any queries that you might have, however trivial.
So you've spoken about pensions and EIS. Can you kind of explain what the difference is between putting money into maybe EIS or should you top up your pension?
I look at pensions as a useful monthly savings vehicle. So again, for anyone who's PYE, it helps them to pay into a pension on a monthly basis the same time as they get paid. They don't really miss it. EIS, I see it as more of a lump sum opportunity. If you have money in the bank that's doing nothing for you, as a high rate taxpayer, I really feel very strongly on this menu board, as I refer to, that it would place very highly before you look at things like paying back a mortgage or indeed any other forms of investments. So it comes back to this complement. EIS is obviously shorter potentially, 4 to 5 years. Pensions can be longer term, albeit, as I said, you can access them from 50 years of age. So there's no one fits all, but I think it's a case of maybe understanding the differences and deciding what best works for you, but ideally having a complement of both.
So on that, what would be the recommended amount that you would suggest putting into EIS?
The minimum amount for EIS is 5,000. The maximum amount is up to 250,000. Now, for that to happen, you have to have an income of up to 295,000 euros. Having said that, this is an individual scheme. So if you're in a relationship and your partner is also earning over 40,000 euros, they can avail of EIS. And as I say, it's more about understanding that this opportunity in EIS is likely to last. If it doesn't end this year, then it probably will end next year. And what I say to people is it's absolutely worth, in this difficult climate of, low deposit rates and uncertain markets, to consider these tax schemes. They are extremely effective. I'm just going to talk briefly, guys, about one last opportunity, which is basically trying to reduce the tax that your children may pay in the future. Now, I appreciate that this may not necessarily be the first thing in your mind when you wake up in the morning, but I suppose the key thing to understand is that your children can only benefit from 335,000 euros as gifts or on your passing, on your demise, after, through your lifetime. And that can be swallowed up very, very quickly, as we know, because of the cost of property. And by the way, this is the property value in the future, 20, 30, 40 years from now. And that rate, the 335, is not index linked. It has been like that for several years, and it's fallen at the moment. The key thing is that you might say, well, okay, what benefit is that if I transfer a property? Well, there is a savings account that you can actually avail of, that you can put money into over a period of 8 years that can help you cover this. And I just want to give you a quick example of this. Let's say you've got one child and you have a house you live in worth 500,000 euros. You obviously want to pass that property on to your child. If you decide to do it, obviously, at the future, or if you buy another property and you give them the property, there will be a tax bill, which is 33% of the difference between the value of the house and 335,000. Very simply, that's 165,000 excess at 33%. That's about 55,000 euros. They will have to sell the property if there are no funds available in order to pay the tax. Seems very unfair, but that's the tax system in Ireland. However, if you've been in the position where you've been able to fund a savings plan, and the example I've used here is 6,000 a year over that 8-year period, with interest, that should very conservatively generate the 55,000 needed to pay the bill. It's a really useful savings vehicle. And all you have to do when you set up the savings plan is tick one box. And if your situation changes and you don't need to use this, let's say you decide to do something else, it just becomes an ordinary savings plan that you can use for future use. I really would encourage anyone who might have this problem to consider it.
Is it likely that the threshold will increase for what you can gift or pass on to your children?
The interesting thing is that this amount was actually north of 500,000, and it's subsequently been reduced. So not only has it not been indexed, so it hasn't gone up in line with the cost of living increases, but it actually has fallen, and it's likely that they're going to lower it further, particularly if there is a change in government. So again, this is where guidance comes in, and we're saying to people it might be worth looking at what your assets are. If you are looking to try and give, obviously, any of these over, to consider the implications of doing it now as opposed to in the future. I'm going to talk quickly as well, just one last example on this. Let's say you have assets over 270,000 and you've got 2 or more children. One of the other opportunities, and this is probably more relevant to all of the people listening today, anyone who has children, that you can save for their 3rd level education, for their deposit for a house, and you can do it very simply in a trust, which again sounds complicated. It's not. It's again just a tick box on an application form. where you can gift your children up to 3,000 per parent, 6,000 if there are two parents, and then it falls outside of that 335,000 threshold. There is no benefit to you giving your children 20,000 as a lump sum in any given year at any stage. You should do it on a drip basis through a plan like this. It would make a lot more sense. And this is something that we talk to our clients about, particularly if you've got, children who are young that you want to just save for, say, third level. It makes a lot of sense to consider this in that environment.
And in relation to the small gift exemption, which is obviously 3,000 per year, if you give this, does it need to be put on the tax return?
It actually doesn't. And one of the things I like most about the small gift exemption is it's so simple. The only thing you need to have is evidence, if you're ever caught up in an audit, to show that you made that contribution to your child. We really like using the life assurance company savings vehicle. The example on the screen there is through Zurich, for one of our preferred providers. And again, it's really important to watch out for fees and do talk to us about what the fees should be. We offer no entry costs or exit costs to these plans, where you can set these up and you've got complete freedom of payment. You can stop them, but more importantly is that they're able to be used in this way without any need for an accountant or indeed anything that you have to do out of the ordinary.
I'm just going to move to one of the questions that's come in, and then we'll address the others. But I think it's from the previous example, Nick. Won't your child have to pay tax on the 48K?
No, they don't. I mean, that would defeat the purpose, obviously, of doing this in the first place. The savings plan that I refer to is called Section 73. I can send some example of this to you. The whole point of it is that the adult is the one that's saving, and the point of the Section 73 is that it forms outside of the estate, and it can just be left there until a later time. The only qualification is you have to do it consistently for 8 years. You can vary the amount you put in. I use the figure of 6,000 by 50% plus or minus in any year. And as long as you qualify for those criteria, then that's absolutely fine, and it can be used for that purpose.
And does the children's allowance payment invested monthly in an investment fund qualify for this?
No, it doesn't. The purpose of the Section 73 is that it's done in the adult's name. The child account that I've used is basically for this gift exemption. Now, it's a really good question, and it would be lovely if it could be, but they both have slightly different tax purposes, but they both are effective in that, guys. One of them is to pay a bill, the other is to avoid a bill.
So moving back to pensions, Nick, is there a figure for AVCs that you should not exceed?
Yes, absolutely. So the example I used earlier, which I'm just going to go back to, this age-related table for a PAYE or a self-employed person is one that you should not exceed. Now, you can go back 1 year. So for example, let's say you were earning 50,000 euros and you were in your 30s. 20% of 50,000 is 10,000 euros. If you had not paid, say, let's say you paid 5,000 euros into your pension last year, you can pay 5,000 for last year and 10,000 for this year, but you should not exceed that. Now, AVCs plus your normal contribution, i.e. your total payment, should not exceed those limits. Now, if your company are making the contribution, as I said earlier, there is no limit to that. They could put in an extra 10%, and you can still put in the 20 or 25% depending on your age. Some people think that they're combined, they're not at all.
So as you approach retirement age, when should you stop making AVC payments for a career average DB pension scheme?
That's a question that I might take separately, if that's okay with you. There's a little bit more information that I might get, but it depends on how many years the scheme rules allow for and how many years you've been a member of the DB scheme. But the key thing is that you just don't want to exceed the threshold of the 2.15 million, which currently applies in Ireland. Other than that, there is no real limit to when you should stop the AVCs.
And in relation to the EIIS, Nick, what's the timeline for getting the rebate from revenue?
For the Two of the companies that I mentioned that are singular companies on EIS, the rebate is expected back within the first 2 months of the year. For people who invested in Blacksmith Kinsale, for example, they're going to be receiving their certs next week. That's the end of January, which is very quick. So again, that 4,000 on a 10,000 investment will be given to them within a week or two after that. Once they put in the cert into the Ross system, which we help them with, it's a really simple process. For the funds like BVP, because they invest in typically 8 or 9 companies, that can take slightly longer. It could take up to 9 months into the following year. But again, it's worth knowing that we suggest diversification, which is why we have 3 companies listed, and it's more about the opportunity to the individual.
So if you invested in EIS, are you taxed on the 4K rebate that you get?
No, the 4K rebate is tax relief of tax that you pay in the current year. So it's completely tax-free.
And can you explain a little bit about, or what would you recommend, I suppose, doing with anybody that has an old pension, especially one in the UK? I know that there's been a lot of queries around this recently.
I worked in the UK many, many years ago. I actually came to Ireland in 2000. And interestingly, this week, I applied to buy state pension years. And I was surprised of how easy and how cheap it was. And anyone who has worked for 2 years or more in the UK, I would strongly encourage you to get in touch with us. You have until April the 5th this year to apply to buy back your pension years. And I can go back as far as 16 years. If you wait until after April, they'll only allow you to go back 6. And I think it's a huge opportunity. It costs £150 per year you buy, and you'll get the equivalent of that on a weekly basis. It's a complete no-brainer. And as I say, it's an opportunity. For anyone who has ex-Irish pension schemes from previous employments, I had a few conversations with people today who worked for companies, and I appreciate there's a lot of movement at the moment, particularly in the tech sector and obviously certain industries. And what I would say to you is that, as I said earlier, it's worth exploring your options in terms of phased drawdown of these schemes. A lot of advisors will try and move you into a pension for their benefit. And I think it's really important to get independent advice and to know where your pensions are invested, get someone to do the pension calculator for you, and make sure that you're on the lowest fees possible in the right funds. And we'd like to feel very strongly that we can give you that guidance and advice.
And you mentioned fees. Can you just explain briefly the fees associated with EIS?
Very few financial advisors deal with the EIS scheme for 2 reasons. One is that the fees are very low. Typically, we charge somewhere around 2% for an investment contribution. So if you think about it, if you invest €10,000, we provide you the documentation, we provide you the application form that we do electronically, as we do with all of our forms. It's really simple. And you pay €200 to Alpha Wealth. That's your all-in fee for the process of 4 to 5 years of us managing your money. So it's a really cost-effective sort of vehicle from that perspective. And that's, again, why a lot of advisors don't do it. And as well as that, I said 2 reasons. The second is that they don't really necessarily have the wherewithal in terms of dealing with these companies and having the ability to basically funnel them in to the best 2 or 3.
And I suppose you've spoken about, again, pensions and EIS. If you invest in the EIS scheme, can you put the return directly then into your pension from what you've...
You can, absolutely. And I think that's a really good way of looking at this. I always like people getting a double win. So let's say you invest in a pension, you get your tax relief. You can then put that money into an EIS scheme and get further tax relief. Or indeed, let's say you're a company employee and you benefit from shares that you either get or you pay for at a discount and they vest. And I do believe that a lot of people should absolutely, particularly given what we've experienced over the last 14 months, sell the shares in your company when you can, keep buying them and use the proceeds of that shares to invest in EIS. If you happen to have lost money in the shares, you can benefit from the gain in the EIS without paying tax on the gain. And if you've made money, you can therefore benefit from the tax relief. This is what I call the win-win.
So can you provide a little bit of advice on occupational pension schemes if moving company after many years of service?
Absolutely. As I've mentioned earlier, it's really important to know that when you move from an occupational pension, which is just basically a company pension plan, what the value of that pension is, what are your options in relation to moving it to your new company scheme if you join a company that has a pension, whether it's better for you to leave it in the previous company, which I generally don't think is a good idea. And the third typically then is to move it into a pension bond, as it's called, which allows you early access. But the key thing is get independent advice and make sure you don't pay too much for it. As I said, we've seen advisors out there that are charging anything north of €1,000 for financial consultations. Now, I'm not going to knock the advice that they give. What I am going to say is, and this is us representing Alpha Wealth, we're charging anyone that books a financial review through us and mentions that they've attended a webinar a cost of €99, which we'll provide until the end of this year, where we do a full financial review with them. We give them guidance and advice. It's not a pushy, sales-driven process. We can show you the pension projection that I showed you earlier for your own specific purpose, and there's no hassle, and there isn't any drama in doing that for you. And we'll show you how to save money. I feel that I'm very well versed, as are the people in Alpha Wealth. We have over 60 years of experience showing you can save money in your mortgage protection, your insurances, and it's a good financial health check. And all we ask you to do is give us an hour of your time. We can do it over Zoom or in person. And we ask you to allow us the opportunity to just get the information on your behalf. It doesn't cost you anything further. The cost, as I said, is €99. And I think it's well worthwhile.
I think that's all of the questions that have come in this evening, Nick.
Great. Well, just want to thank you very much for your time. I appreciate you answering the questions on the poll. I suppose the results of which were that it seems that the majority of people paid more than 20,000 in tax. So hopefully you took something from today. For those of you that said that you're not sure, it's probably worth exploring. I see somebody has raised their hand there. If somebody would like to maybe ask a question, if you want to throw it into the Q&A, we are going to sort of wait behind. And obviously, I'm happy to take any further questions if people want to. And indeed, just pop me an email. My email address, guys, and I know some of you may have it already, but for those of you that don't, it's very simple, just nick@alphawealth.ie. Or you can get in touch with me by phone. There's no cost if you want to contact me for a conversation, for a chat. If you have a question, the €99 that I mentioned earlier, that's for the review. And as I said, I think it will be very useful and beneficial to people just to get a financial health check and see where you are. I'll advise you, as will my colleague David, as to what we feel are the most appropriate areas, and we're well expert in doing so.